Siva, what do you make of how the bond market is receiving this policy? Are you saying that it is considering the commentary as not as hawkish as anticipated?
I think there's a balance. On the one hand, of course, we do worry about the inflation pressure and the fiscal slippage. So that's still the number one factor which is on RBI's mind. Having said that, I think, yes, the tone of the conference also suggests that they are sensitive to growth. And a couple of other points, including, for example, the fact that they recognize that there has been a lot of tightening of financial conditions through rise in market yields already without them having to now come in and hike rates. So I think on balance, the interpretation is that yes, this is roughly in line with what we expected. Not a very hawkish statement. At the same time, reasonable focus on the inflation and fiscal factors.
Does this cap bond yields or provide some sort of ceiling to bond yields for at least the near term?
I think it does take away the risk of an RBI hike in the very near term. Of course, with August having been the last rate cut, it is already very unlikely that they will do anything in the very, very near term. But it does seem to suggest, especially if they have confidence on that 4.5% year-end inflation number, that they may remain on hold for an extended period of time. And that could give some kind of relief to bonds. That is one of the factors that bond markets may not have to worry about in the near term is the RBI. Given that we are already having a lot of concerns on global factors, on the fiscal, the MSP, import duties, and so on and so forth. So I think this is one thing that the market certainly will be relieved somewhat.
So you would say that you expect bonds to stay between what, 7.5 to 7.6, given the conditions prevalent? Of course, I'm not factoring in higher crude oil prices or, further volatility in global markets of any sort.
Well, in the near term, obviously, you do have a bond auction at this end of this week, and then there is an open space until end of March when there are no more auctions. So it's likely that bond markets are likely will remain in a range around here. The real interesting question would be when first week of April rolls around and you start the new borrowing calendar, whether the markets can actually absorb the kind of supply. So I think, yes, in the very near term, maybe this month and next, we do expect markets to be broadly range bound.
Okay, Siva, I have one more question for you before I go to Mr. Joshi, and that is, please interpret this comment from Viral Acharya for me. I would like to reiterate, Dr. Acharya said that RBI's liquidity operations are driven by its monetary policy objectives and the need to meet economy's demand for reserves that also factor in the indirect liquidity injections through forex operations. Except in rare, extraordinary, economy-wide circumstances, the goal of RBI's liquidity operations is not to manage directly the prices of any particular long-term asset market.
I think this it goes to the crux of the fact that once they put out that objective of neutral liquidity, and now this is nearly 2 years ago, that the RBI's core liquidity operations, which would be open market operations and forex operations, would go towards just addressing the core liquidity needs of the system, which is in the nature of expansion of bank reserves and the currency in circulation. So what that seems to suggest is that they are not interested in the short-term fluctuations. So occasionally you could have the system in deficit mode and occasionally in surplus mode, but they would probably be looking to smooth those out using just the normal policy tools like the repo and the reverse repo. But the liquidity will be focused using the longer-term operations, that is the OMOs and FX operations would be targeting the normal expansion in liquidity needs of the economy. I think this is broadly consistent with what they have said in the past. Now, the risk to this is when you have extraordinary inflows of FX like we've had this year, when we've had over $20 billion come in, then the RBI neutralizes or sterilizes that by doing open market operations through sale of G-Secs, and that adds to supply pressure for the market. And I think that is something we need to be watchful for, that if FX flows continue to remain strong and more than what RBI believes is necessary, we will likely see more RBI OMO sales. But that's not something we are concerned about in the very, very near term, but over a period of time, that's something to keep in mind.